estate plan. So in progress. What's interesting is that we all have an estate plan. It may be one that you have prepared yourself or one that the state of California has prepared for you. So the state of California has the probate code, and it has the default provisions of what happens when a person passes away and they don't have an estate plan in place. So the default provisions are as follows. And by the way, it's not specific to California. Every state has its own probate code. I just happen to practice in California. I'll give you some numbers, but wherever you happen to live, your state has specific default rules. What would happen to your estate? So in California, if you own $166,000 or more, which is really not that much to start with, your estate will go through probate after your passing. It will be stuck in courts 18 months, and 18 months was pre-COVID numbers. We're now looking at more like 2 years. Your estate will be stuck in the courts. It delays the distribution to your beneficiaries, especially if you have beneficiaries who are dependent on you, who are minors or need to be taken care of, need some kind of financing. It's all part of public files, and it is incredibly expensive. So it could be anywhere from 4 to 5% of your estate you will end up paying in probate fees. If you have minor children, the other thing that happens is courts get to decide who gets to be their guardian, and courts get to manage your children's money until they turn 18. Once they're 18, the children are adults and the courts no longer manage it. They'll give everything to them at 18. Next slide, please. So in order to avoid everything that I told you about going through the court process, going through the probate process, you can say, I don't want this default estate plan to apply to me, and you get to change and prepare your own estate plan, whatever it may be, whether it's with a will or with a trust, but you get to be in control over who gets your assets, how they're distributed to them, at what age, what happens when you have a spouse, when one spouse passes away, how your children inherit assets, how your favorite charities inherit your assets, how your best friend inherits your assets. And even more importantly, what happens when you're incapacitated? We had a lot of issues during COVID where family members were in a hospital and their loved ones didn't know what to do. So we looked into their estate plan, and which gave other people to make decisions, financial decisions for them and healthcare decisions for them when they were not able to make those decisions themselves. Next slide, please. When you speak with an attorney, whatever state you happen to be in, typically the backbone of your estate plan will be some kind of a trust. We're talking about a revocable living trust. Revocable means it's changeable, so you can prepare something today. This makes sense for your family now. 5 years, 10 years, you can always update it. And living trust means you're preparing it during your lifetime. So this is a trust prepared while you're alive. The best way that I like to describe a trust is think about trust as a basket. So whether you're single or you're married, you with your spouse or by yourself will prepare a trust. And those are called the grantors. You will put certain assets into it, whether it's your house, whether it's your bank accounts, whether you name the trust as a beneficiary of your life insurance. So there are assets inside the trust. And while you're alive, you're typically the beneficiary. So you can create it and manage it, and with the hopes that your trust, your basket will continue to grow as you accumulate more assets over your lifetime. When you pass away or you're incapacitated, you will designate somebody else to step in and manage the funds. If the grantor, the person who created the trust, is alive, they can designate somebody else to step in and manage the funds for their benefit. So even if the person who created the trust no longer is capable of managing their assets, whether they are elderly, whether they have some kind of a psychological or physical inability that's preventing them from making those decisions, someone else can manage the assets, invest the assets for their benefit, and pay for their needs. Typically, after the person who created the trust passes away, that's when things will be passed down to their loved ones, whether it's family members or their favorite charity or their best friends. That's the beauty of having a trust. You get to decide who inherits your assets versus the probate law, which has your heirs listed specifically how those individuals can inherit from you. If you have children, you can also decide that instead of giving everything to them at 18, which is what the law provides, you can decide to give them some funds at 25 or when they graduate college, some at 30. You could also have assets be available if they want to buy a house, if they want to start a business. If they have a loved one who's sick, you can account for grandchildren and so on and so on. So depending on the type of a trust you want to build, you could take care of your children and create even a dynasty trust for the next generation after.
So I got a quick question. Real quick, we got a quick question. And also, I don't know if it might help, but see if muting on your end might help with feedback. If it continues, we've tried every other factor. I'm sorry about the technical difficulties, everybody. But one question was, how often should you change or update a trust if it's a revocable trust? Any rule of thumb you want to provide for people?
It's a really good question. So you will update it when it's necessary, but I think it's a good idea for you to review it with the person who prepared it. So we usually will do a review with our clients every 3 years, but we'll also tell them if there are any major updates that happen in their lifetime. You have another child, you have a grandchild, there's a divorce, there's a death. Maybe the people you designated as trustees have moved. Maybe you got an inheritance. Maybe you have a business partner. So it just depends on major updates that happen in your life, as well as what's going on with the law. So rule of thumb for us is every 3 years, but I tell clients, if anything big happens, give me a call, let's talk about it. I'd rather talk to you before you make any decisions versus they make a decision and then we have to go back and update it. The other one would be purchase of a house or selling of a house.
Yeah, 100%. Life events, new baby, new spouse, divorce, those are all things on the life side too. Our rule of thumb is every couple of years we try to touch base with clients, just because sometimes they've moved, sometimes they've not gotten around to their trust yet, and we're trying to nudge them that they really do need to make sure they do that. But it is really important, because sometimes you get a life insurance policy, you've named a certain beneficiary, you've gone through a whole divorce, and you forget 15 years later that this woman that's not even your spouse anymore is the beneficiary of your life.
Yeah, we see that.
It happens. Another question we
got
was
another question about moving. I think Lisa asked. Lisa, you're absolutely right. That would be another thing to consider. Estate planning laws are very state specific. So if you do move to another state, you want to have an attorney in that state take a look at your trust and see if it's still relevant or if it needs to be updated to be relevant under those laws.
Yes, and there's also a question about how do you know approximately if you're above probate? In California, it's like, what if you're worth more than like 200K, right? You're going to go through probate.
66,000. Yeah, it's a really low threshold. And by the way, when we're looking at 166,000, we're looking at the gross value of your estate. So you may have an expensive home with a large mortgage on it. If the value of your house exceeds 166,000, which is literally every house in California, you will be in probate.
Yeah. So pretty much, unless you're pretty much destitute, you probably will go through probate, and you, believe it or not, you probably want to do a trust and a will. Okay. So next slide.
Thank you. So once you create the trust, not only is it important to have the trust with the specific provisions, who gets your assets, how they get it, but it's also very important to put the assets inside the trust. So it's called funding the trust. Funding means if you have real estate, you will change your deeds to reflect now the titles in your name as a trustee. If you have bank accounts, you will change the titling on the accounts to be in the trust name. If you have life insurance, the life insurance beneficiary would be the trust. So not only do you want to make sure you have a trust in place, but that the assets are properly aligned with the trust as the beneficiary. There are certain assets we cannot put in the name of the trust precisely. Those would be IRAs, 401ks, annuities. Those are tax deferred accounts. So those you always want to have in your name. If you have a spouse, you typically will name the spouse as the primary beneficiary because there are different tax laws that benefit spouses, and then the trust will be the contingent beneficiary. So those assets will stay in your name, but ultimately we'll have the trust as the beneficiary. Next slide, please. So a lot of clients will say, why do I need a will if I have a trust? A typical will say, when I pass, I want things to go to my spouse, to my children. When you have a trust in place, the type of a will you will have in conjunction with your trust is called a pour over will. And again, we're looking at the overall estate plan. We want to make sure that everything you have ends up in the trust. So pour over will say, upon my passing, if there are any assets that I left outside of my trust, outside of my basket, pour it back into the trust. So we want to ensure that not only is the trust in place, not only are the assets inside the trust, but if we, for some reason, forgot to put one of the assets in, your will dictates that it will all end up inside the trust, and the trust will be the vessel by which things will be distributed to the loved ones that you've designated. Now, another important thing in putting an estate plan together is if you have minor children. A lot of clients will come to me and say, I have no assets, but I have kids. And really, that's the driving point in coming to you to make sure I am the one nominating who will be my child's guardian. So again, if you don't have documents in place, the probate code has a hierarchy of people who typically will get your children. That would be your spouse, then your parents, your siblings, your nieces and nephews. As you can imagine, with the political climate in the last 4 or 5 years, we've had a lot of families disagreeing on certain things. And what I've seen more than anything is people coming back and removing certain family members from ever acting as trustees. You know, I know my, my father-in-law, this is what he thinks about current politics, and there is no way that they will ever get control of my children. There's no way my children will ever move outside of the state to go live with them. So not only can you specifically designate and say, I want so-and-so to take care of my children, but you can also prevent certain people from getting your children. This is especially important if you are thinking of nominating non-family members. So let's say you want to name your best friend as the guardian of your child, who typically under the law would not be entitled to be the guardian. It's really important you have this in writing and properly designated so that it's not a question after your passing that that person, your best friend, will be your child's guardian and not your parents or in-laws or anyone else you don't want to handle. If you are going to name someone who's out of the state or the country, you also want to have a temporary guardian in place. So on a temporary basis, 24 to 48 hours, if there's an emergency, that person lives within 10, 15 minutes of you, can come stay with your child until the permanent guardian is able to travel and come be with your child. So it's really important that we're thinking of not only the long-term, but also the short-term guardians for the children. And what I see a lot in my practice is people will designate guardians when their kids are little, and then they will come back when the children are teenagers to change them to someone else. It would be typical for someone to name their parents. And as their kids get older, the parents get older as well. They'll come back and say, I think it's time to name my next door neighbor or my best friend's parents as the guardian versus my aging parents.
There were a couple questions, Sona. One said, if you're unmarried, who comes after a spouse?
So the child's parent, if there's a second parent, or sometimes now we could have a third parent, those people would be the ones who get the children. If you're unmarried and you're a single parent, then it would be your parents, your siblings, and then nieces and nephews. If you're married, it would be both sets of grandparents, all aunts and uncles to the child, and their cousins.
Thank you. And then also someone asked, I know this is an out-of-state investing client, or not so much, but some of us have investments and might have assets. So what I'm trying to say is, if you have investments out of state where you live, do you have to have a different trust for that?
Not necessarily. So I do have clients who are California clients, and let's say they have real estate in other states. We can put real estate from another state into California trust. So for example, I handled an estate where California, the spouses had a California property, they had a Nevada property, and they had a Texas property. And we contacted an attorney both in Nevada and Texas who helped us transfer those assets into a California trust. If we did not do that, because this was real property and the clients passed away, there would be 3 separate probates, one in California, one in Nevada, and one in Texas. The same could be done with investment accounts. Just because the investment account is located in another state does not mean you can't put it into California trust. Sometimes, strategically speaking, it makes sense to do it to separate things out if something's community versus separate, but typically speaking, you can do it all within one trust.
Very cool. And going back to the guardian thing, I wanted to share, when people are picking guardians, you have to remember there's also ideally insurance that's funding things. So you don't have to necessarily just pick the person who is the most wealthy to take care of your child. So for example, if one set of parents is a better, quote, parent in alignment with your values, but they don't have as much in terms of money as one of the other sets of grandparents, it doesn't matter, because you get to have the life insurance fund your wishes and even support those who will be the guardian for your child in taking care of that child. So that's part of one of the ways in which the funding with life insurance and the work you do in estate planning go hand in hand. It opens up possibilities.
That's a really good point you bring up.
Mm-hmm. Yeah, it's really good, because you just realize that you have control. You have control according to your real wishes, as opposed to what you think is the exigent way to try to make sure your kid will be fed.
Mm-hmm.
Okay.
There are a few other documents that should be part of your estate plan. One would be a durable power of attorney. This would be a document where you designate someone to make short-term financial decisions for you. I will tell you, during COVID, out of all the documents that we prepare, clients who ended up in hospitalized long-term, this was the document that a lot of their loved ones were able to use to kind of take care and manage their everyday finances, paying bills, opening their mail, talking to the bank, caring for their pets, paying the nanny, paying the gardener, kind of dealing with everyday short-term financial decisions. When people think of estate planning, they always think of what will happen when I pass away. But a lot of times there's a lot of gray area of incapacity, whether you recover from that incapacity or the incapacity deteriorates to the point where the person passes. And you want to make sure that you have that gray area covered with your documents as well.
100%. This happens a lot with, yeah, I was just gonna say, this happens a lot with long-term care, when people are victims of strokes or getting incapacitated, and they may not be dying for quite a number of years, but they may not exactly be in capacity either. Mm-hmm. So, okay.
Just a few things to consider when you're choosing your agent for power of attorney. So we will talk in a little bit about healthcare directives, but you don't have to always name the same individual. So think of someone who's personally responsible and does well with their own finances. This would be a person that you would trust with a lot of personal information, like access to your bank accounts, access to online passwords, and make sure that this person, will listen to what you want them to do and then carry out those wishes as well. Some things to consider when you have adult children. Do you want to have one of the children out versus all of them together, which could be, sometimes it could be a blessing, but sometimes it could be an impediment, right? So there's 3 children and they all want to act together. Sometimes it takes a lot longer for them to send out checks and do certain things for parents, whereas you just name one person. So definitely consider family dynamics. And sometimes clients just choose to have a third party who is not related to them at all act. So those are all things to consider when you're choosing who will make financial decisions for you.
Mm-hmm. If you imagine they're inheriting millions of dollars, who do you trust to be responsible with that?
Absolutely.
As their personal kitty.
Mm-hmm.
And the whole thing of getting siblings degree, oh my gosh, good luck. It's a lot harder than you think. So
it really is. So the other important document you should have as part of your estate plan should be an advanced healthcare directive, a document that will specifically spell out your end of life decisions, how to dispose of your remains, whether you want to be an organ donor, whether you want to be getting some kind of palliative or hospice care. These are such important things to reflect on and for you to make those decisions. I had a situation recently where clients went to a paralegal who prepared their documents, and the husband, he had COVID. He actually is an accountant, went to his office to stay there so his wife and children could be healthy. He went for a walk, he fell down, and he had a brain injury, and he ended up in a coma, all from him getting COVID and trying not to get his family infected. So when he was in a coma, his wife said his wishes were he would not want to live this way, and he wanted to be taken off life support. Lo and behold, we look at their documents, and the document says to keep him alive at all costs. And she is crying and saying, this is not what he wanted. And he has children from a prior relationship who are claiming that's what our dad would have wanted. He wanted to stay alive, and we want to keep him alive as long as possible. A colleague of mine handled this case in front of a judge. The wife testified, the paralegal who prepared the documents testified and said, I made a mistake. I think it was his wish to be taken off life support, and the court sided with the document. He said, this person cannot speak for himself. All I have is a legal document saying he wants to be kept alive at all costs. It was incredibly devastating. Unfortunately, this elderly gentleman just passed away after 11 months of being on life support. So it's so important for you to understand what you're doing and your documents properly reflect what your wishes are. And also for you to share it with your family members, right? For them to know, this is what I want, and I want you to be okay with this decision that I've made. So then they're not fighting after the person's gone. Can we go on to the next slide?
Yeah, sure.
A few things to consider when you're choosing. Oh. You know what? I like the idea that you skip this. I do have this, and we can definitely share it with other people. Just I wrote down a few things to consider for when choosing a healthcare agent. But I would love to move on to talk about life insurance trusts. I know we're a little bit behind on time. So far we've spoken about revocable trusts. Revocable means they are changeable. But as part of your estate planning strategy, you may also consider having irrevocable trusts. The specific trust that I'm talking about is an ILIT, life insurance trust. And these type of trusts are typically created and funded with a permanent life insurance policy to account for any estate taxes that may be due down the road. If you think about it, currently we have the highest estate exemption ever. What that means is how much money we can give away at our passing without paying taxes. It's a little bit over $12 million a person. So per person, we can give over $12 million before it's taxed. But this law is going to sunset by 2025, and there are all these rumors that it will not be extended. And if it is going to be sunsetting, it will go to its prior exemption, which was $5 million, and it's adjusted for inflation, so it would be around $6 million. So the number of assets you can give essentially would be cut in half. So in order not to sell or liquidate your portfolio or your real estate in order to pay estate taxes, a great strategy is to prepare an irrevocable trust funded with life insurance. And after you're passing, the life insurance is paid into the trust, and that's what could be used to pay for estate taxes instead of having to liquidate your real estate or other accounts and assets. And this is actually even more important for business owners, right? Because liquidating a business in order to pay taxes would be incredibly devastating if you're trying to pass that down to your family members.
Yes, and obviously the cost for the permanent life insurance is way, way less than the cost for the estate taxes. So this is what a lot of estate planning attorneys call the freebie. It's a great way to think ahead and use planning for advantage, for financial advantage. Which gets to, why do we use life insurance so closely and intimately with estate planning? It's because it's the only financial product that provides immediate, tax-free, liquid on a dime. Nothing else that's in the financial sector is built that way. So most of the assets that most people will have other than their life insurance is going to be taxable in some shape or form. And the death benefits are always 100% tax-free. So when a person dies and 2 weeks later, that $1 million death benefit is paid out, that's $1 million of tax-free cash. It's a check and you just deposit it and it's in yours. It's now yours. And so it's a really useful tool for planning because we have precision in terms of some known factors. And that makes it possible to build plans around other things. So for example, we don't know when we're going to die. Some of us will hopefully make it to be, well into our 90s or centenarians. And some people might, be a week away from passing. And because we can't predict that with any certainty, I mean, we can have guesses based on lifestyle, but we really don't know. We can't say, well, I'm going to make sure that all my assets have built up so my kids are going to be just fine, because what if you pass away 15 years sooner than you expected, and then they lost the one person who was going to be the breadwinner for the family, and then all those potential assets never did get created, or things had to get liquidated because of an estate situation because someone died unexpectedly, and it was a terrible time to have to sell that family home or that second property. All kinds of things that we can't control, but what we can control with life insurance is the exact amount of death benefit, the fact that it will be 100% tax-free. We know exactly what it will cost because all that gets figured out during the underwriting process. So you have a sustained and predictable expense. And then you can use that as part of the ways in which you're planning and protecting. Another thing is if you live too long. So you think you can sort of just grow your assets and then get into old age and then live off of them. But what if you end up living 20 years longer than you expected, which is happening more and more, and everything you were able to accumulate runs out, which we actually see a lot of that happening. We see a lot of advisors coming to us saying, this person's kind of getting nervous because they're nowhere near kicking the bucket, and they're not as wealthy as they once were because they've been using it up. So there are tools that insurance is able to provide that will give you sustainable income or reliable income so that some piece of things is going to be handled by the insurance carrier instead of you taking all of that risk on yourself. And then of course, when you become ill unexpectedly and you're losing income but not dying, that's a whole other situation. And the nice thing is a lot of life insurance products today are able to cover for all of those sorts of scenarios, where life insurance used to be just, death benefit purely. Living benefits have really come to evolve over the last 20 years. And there's a lot of interesting ways you can use those to advantage in conjunction with the other planning that you're doing. Just a concrete example to try to help bring this on into fruition. We have an example of a large estate where it turns out that they are going to be above the threshold, whether they're a $27 million estate and the limit is still 26 million, or if it's in 2020, say 2027, and you can have $12 million tax-free, but the rest is all taxable. Let's say somebody's got a $15 million estate. And the second parent is when the estate taxes come due. So once the second parent has passed away, then there's an estate situation, and then there's going to be taxes due. Well, the heirs are left with figuring out how to do all of this, right? They're having to try to liquidate assets. Maybe there's a fire sale on a family home or a business, as you said. There's also a tendency for a lot of unfortunate disagreement, different opinions about whether that. I have a dear family friend who there were 3 children, and the second parent passed, and one refused to sell the family home, and the other 2 definitely wanted to sell the family home, and now none of them are speaking to each other. It just destroyed the family. But so that's one option, right? Is no planning, and then you leave all this behind you and it all hits the fan and it goes however, whatever happens. Or with planning, you can have a tax-free death benefit set aside that immediately infuses the estate with the ready funds to pay that tax bill. And also, it was a tax leveraged liquid infusion because you didn't pay anywhere near the millions of dollars of death benefit that you're receiving. You paid a premium and it was all amortized, and you got somewhere between a 10 and 100x return on that. So I hope that helps a little bit paint the picture for larger estates, how the permanent death benefits come in handy. And then with smaller estates, let's say you're not even going to worry about estate taxes, but you have a two-parent home with some children, or even if you're a single parent, if unfortunately one or both parents pass away, you have a lot of vulnerability. There's a lot of financial strain. There's loss of income that you were planning on creating to pay for that mortgage, for example. And then sometimes it's, well, we can't afford the mortgage and now we have to move, or we're going to go move with family because we thought there'd be two incomes, but now there's only one. All those stresses create, like I was saying, that snowball effect. But with simple planning, you can just have a tax-free death benefit immediately there, and that infuses the family with the space and the time that the only thing they have to do is heal. There's plenty of money. I remember a client once said that their mother passed away early on, and the dad had so much pressure that he just had to go right back to work just to try to be sure that they could keep paying the bills, and there was no time for anything. And she said, I just wish we could have taken like a healing trip to Italy just for 6 months to just grieve and get back in on with their life, that they couldn't because there were the pressures of trying to continue to survive. So it helps take away some of that survival pressure when you do proper planning. And luckily, if you're working with good advisors and you're planning ahead of time, it doesn't have to cost very much. One of the questions we get asked a lot is kind of about the difference between the different kinds of life insurance. And there are a lot of different kinds, but the way to think about it is there are two different buckets. There's term products, and then there's permanent products. Now, within permanent products, there are many kinds. You've probably heard of variable life, whole life, universal life, guaranteed universal life, index universal life. Some of them, in my opinion, are excellent products, and some of them are, in my opinion, horrible products to run away from and never touch. But all of them will be permanent products in that rather than insuring just a set number of years, they will insure a person until they die, no matter what age they are when they die. So they could die when they're 27 or 127, and on the day they die, that death benefit will pay out. You can't outlive it. They tend to be more expensive because, again, you can't outlive it. They will definitely pay out that death benefit unless for some reason you stop paying the premiums. Term insurance, conversely, is usually for a set number of years. It can be anywhere between 5 and 30 years. So 5, 10, 15, 20, 25, or 30 year. And after you've outlived that term, it expires. So if you bought a 20-year term policy and then lived for 21 years, the premiums you paid for those 20 years of protection were technically money down the drain because you didn't die, thankfully, but you had protection during those critical 20 years. And so there's a value in that. The reason we use term sometimes, it's lots less expensive than permanent insurance, but there are definitely pros and cons to both of these kinds of products. Otherwise they wouldn't exist. Term insurance, I like to say, is kind of use it or lose it. It's like wearing your seatbelt or having your auto insurance. If you've driven around for 5 years and had no car accidents, you could look back and say, oh, that was money down the drain, but you wouldn't go risking that you would go around uninsured because the stakes are just far too high. So it's you're glad if it's money down the drain if you've got term insurance. They don't have any features that, for example, can grow cash inside the policy, or some of them will have living benefits, but not as many of the bells and whistles that you can usually find in permanent insurance products. But they're great baseline protection, especially for families with young children, because you can get a big death benefit for a pretty low premium. And it's usually a big part of a person's foundation with risk management. Now, permanent products, again, it really depends on the kind. And if you ever have questions, I encourage you to come because I will explain to you all the differences between all the different kinds. But some permanent products can actually grow cash inside the policies, and even sometimes with guarantees, which is really nice because you have the death benefit, which is clearly a huge benefit, especially when it's for tax offset. But you're also going to be able to get some of that liquid that you're putting in terms of premium to work for you while you're alive, because the cash growth can grow tax-free and be accessed tax-free while you're alive. So when structured correctly, it can also really be a good part of a person's overall portfolio. Of course, within reason, and it has to be in the hands of the right advisor, but they do have a lot of predictability and a lot of really nice features that you can't necessarily get in other kinds of financial products. Plus that big death benefit at the end. So it really can sometimes be a nice tool. And they're especially good when you're going to do any kind of irrevocable trust. We always end up having to use permanent insurance for that, just because we can't afford to build a whole trust and then have the term insurance, expire before the person passed away. So term and perm, those are the two buckets. Planning is really key when it comes to life insurance and planning ahead. So I just wanted to share why time and thinking ahead is so important, especially with life insurance, unlike any other financial product. You can see here, these are for females. Let's say she was standard health, or she was even super preferred health. You get even better discounts. If you're really healthy, you can save even more money on your premiums. But let's say a person wants $1 million of 30-year term or $1 million of 20-year term. They get it when they're 25. You're getting $1 million for, let's say, $600 a year. By the time you're 45, that's doubled, almost on its way to tripling. And then by the time you're 55, that's tripled almost again, because mortality rates really increase. So the sooner you do planning when it comes to your life insurance, the cheaper the entry point is into the product. And if you're doing anything with permanent insurance products, if the cost of the insurance is cheaper, then the growth and investment or portfolio components of a permanent product will iterate far more favorably for you too, because the internal costs are much lower. So then all the things that those permanent products can do for you over time are expanded because of the power of the compound interest. You can see the older you get, you actually become an insurable. So it's best to try and do your planning before you need it, as with all insurance products. I've literally had calls where people are going into hospice, and I get calls and they're like, can I buy some end of life insurance? And I hate hearing that, because I'm just like, no, of course not. What they're trying to do is amortize risk. So you have to be participating before you need it. Some quick tips: always try to use a broker, not an agent. A broker works with every carrier in the market, like we do at Quantum. Well, at least every carrier that's A-rated or better. But an agent is going to be tied to one specific carrier, and those carriers often have inflated expenses, like Northwestern Mutual, Mass Mutual, and New York Life are the three main captive ones, or State Farm, for example. And not only that, but their suite of products is really limited, and their underwriters have you in a corner. Because if they don't like a certain piece of your health history, they'll rate you, and then you won't get the discounts you can get for being extra healthy. But if you're with a broker, they can get you an offer and then shop it to even another carrier if we aren't satisfied with the health rating that we got, and it gets you a big competitive edge in terms of rates. Just a quick note about living benefits. It's really important you're working with some modern advisors who really understand how life insurance products have evolved, because they've really changed significantly in the last 20 years. I like to say it's kind of like old-fashioned life insurance was just death benefit. It was kind of one of these jalopies. And the newer products are kind of like the electric car. There's a lot of efficiency. They've learned how to leverage all these risks and tools to just make them a lot more valuable. And there's not as much waste in the system if they're using the right kind of products and they're designed correctly. And also some of the old school adages that we all kind of came up hearing, things like buy term and invest the rest, or always get whole life. Those are frankly really outdated opinions that maybe were right in 1985, 1989, but certainly the way products have changed since even just 2005. It's really important that you get up-to-date information and you work with a really strong advisor who's really specialized in insurance, because it's a really complex field at this point. So I know we're coming up on the hour. I would love if anybody has any questions, if you'd feel comfortable sharing.
There was an earlier question that Adapia asked about naming beneficiaries and agents. from another country. So you could have a beneficiary from another country. That's not a problem. So beneficiaries could live anywhere in the world. Or a non-citizen to act on your behalf and make financial decisions. That's not a possibility. So usually we want to have someone who is green card holder and has a social security number when we're naming them as a trustee. That's not really the requirement for power of attorney, but you do want somebody who's local and who can step in and be at your house to take care of you, to open your mail and, you know, make healthcare decisions for you. So usually for the trust, that's a requirement. Otherwise, you need to have another bank act with them. But for healthcare and short-term financial decision-making, you want someone who's local.
Okay, that's helpful. I was thinking about kind of like second in line, like if my, you know, something happened to my husband, you know, who would
Sure.
take care of my dogs. And that's maybe potentially even a different person
Yeah.
than the estate, the person taking care of the estate. So my natural inclination would be my family.
And it's really important to plan for your pets as well. So all of our trusts will have specific provisions. What happens when you have a pet, whether you can designate a decision maker for them to be a caregiver, and you can also specifically give them funds to take care of your pet. So that's one of the standard questions we ask. And I'd say 9 out of 10 of our clients will have a pet and they'll plan for them. So they're just as important to plan for.
Yeah, I know Sona's done some really interesting work in that specific area, so it's cool. We also just got a good question. Can you convert a term policy to a permanent one? Great question. So the answer is yes and no, and it depends on the carrier, because not all carriers have the same conversion products available. And this is a big deal. We work with this a lot. So we work with every carrier, and sometimes of the 3 or 4 top cheapest carriers, we'll know that, let's say, Principal's carrier conversion options are rubbish, but Midland's are fantastic. And so even if it's like a difference of price of $7 on the term cost, you'd probably want to go with whichever one had the better conversion options, because if you do want to convert, the real question is, are you converting into one of those value-rich permanent products that are available today, or something like their whole life product, or a variable product, which would be even worse, which would be not such an advisable thing to convert to. See, conversion happens only when you're in a corner, because if you've almost expired your term and you're going to convert, it's able to be converted guaranteed issue, or sometimes with limited underwriting. But if you're healthy at the time your term is expiring, you'd probably be better served replacing it with a new policy at the time, because the conversion products that are the inevitable, like the only last stop for someone who's sick and can't get it anywhere else, you're going to take what you can get. If you know you're going to be dead in 3 years, you'll pay whatever you have to get that, you know, $2 million death benefit, even if it costs you $170,000 a year, because you know you're going to be dead in 3 years. And so conversion is not always your best deal. Now, some carriers will have really great flexible conversion options. So Midland, which is another one that I tend to favor lately, because they've just been doing this a lot. You can buy a term product from them and convert at any time to any of their full suite of permanent products. And the rates are not inflated because of the conversion. They're actually the same you would get if you had gone directly the first time. So it's very nuanced in terms of that. And the question is just to find out what the options are, because if you're healthy and insurable, a good agent will first look at what you've got, see what the conversion options are. If they're good, you'll probably do that because it's the path of least resistance. But if not, and if you're insurable, they'll just look everywhere else and see about potentially replacing. LLCs versus trusts for investments and how the two work together.
That's a really good point out of Pia. So typically we'll use LLCs when you're investing in real estate, or if you have, let's say, a group of friends coming together to invest in a restaurant or a business or start an investment club. So typically the LLC will dictate what happens to the assets or the investments within the people who are part of that LLC. That's just one part of your estate plan. So let's say you and your husband buy an apartment complex, you'll put it into an LLC, and the LLC protects your personal assets. If something goes wrong with one of your renters, they will only go after the assets in the LLC, the business of, renting them the property. They won't go after your personal assets, your personal investments. So they work together. You wouldn't have just an LLC or just a trust. You can actually just have a trust if you don't have assets that are businesses. But when you have an LLC, you would typically assign the LLC into your trust, into your basket. So it's possible you have your basket with your home in it, but then other business entities like an LLC corporation would also be part of that trust plan. So you could have a trust without an LLC, but when you have an LLC, you should still have it inside of a trust.
Okay, thank you. Yeah, that's really helpful.
All right. Well, if anybody has any other questions, please feel free to reach out to us. You can reach us all kinds of different ways. We have info@teamqis.com anytime for life insurance questions. Sona, do you want to share your
It's
email one?
info@linklaw, and I'll put it in the chat as well. So lynklaw.com. And I'm happy to chat offline and see how I can help. And if you have any other questions, feel free to reach out.
Yep, that sounds great. And also, again, if you've enjoyed any of this or you'd like to learn more about what we're doing over at WOW, please feel free to check us out there as well. We are at www.women, of wealth.com, all one word. You can hear about our mission. We're hoping that this was really useful for all of you who attended. And thank you so much.
Thank you, ladies. Bye, everyone.
Bye. Thank you, Sona.
Bye.
Bye.